Our discussion is about how statutory reserve requirement measures inflation. Monetary policy is a set of tools that a nation's central bank has available to promote sustainable economic growth by controlling the overall supply of money that is available to the nation's banks, its consumers, and its businesses. Besides, these policies are implemented through different tools, including the adjustment of the interest rates, purchase or sell of government securities, and changing the amount of cash circulating in the economy. The central bank or a similar regulatory organization is responsible for formulating these policies. So what is statutory reserve requirement? Statutory reserve requirement is a percentage of special deposits by commercial banks and financial institutions have to keep in the central bank. Changes in the statutory reserve requirements by the central bank will affect the level of savings and loans that can be supported by the bank system reserves. The SRR may be raised to manage the significant buildup of liquidity, which may result in financial imbalances and create risks to financial stability. Conversely, the bank may lower the SRR if necessary to support the transmission of monetary policy rates to retail rates. During inflation, the central bank will increase the ratio of statutory reserves to commercial bank deposits at the central bank. This has reduced the ability of commercial banks to lend. The purchasing power of society will decrease, and the aggregate demand of society will also decrease. Thus, inflation can be overcome. If the statutory reserve is increased during a period of inflation, commercial banks must hold a lower amount of money. Therefore, the ability of commercial banks to provide loans to individuals and firms will decrease. The supply of money in the economy will also decrease. We can conclude that the reserve requirement is a tool used by most banking institutions to maintain the percentage of deposits from depositors. During inflation, the central bank raises the statutory reserve ratio. So commercial banks had to keep more cash in the central bank. This causes the ability of commercial banks to lend and credit creation will decrease. The money supply in the economy decreases, the purchasing power of society decreases, and the price level of goods will tend to decrease. The economy is back to normal.